bought around $100,000 in stocks today, and I'm going to tell you exactly what I bought. When the market's choppy like this and there's a lot of uncertainties, a hot war, I was looking for companies that have a lot of certainty in their future. And if you follow my channel, you know that I spent $8,000 in Gemini tokens to build my own SEC chatbot. That's particularly useful for making long-term forecast calculations on a number of companies at once to narrow down the ones that have the most certainty. The first company I bought was Netflix. Now, I've been looking at Netflix ever since the Warner Brothers Discovery deal fell through. I've been talking on my channel about how the Warner Brothers deal falling through was going to be the best thing for Netflix before it even happened. And I decided to add to my position today. And although this hasn't traditionally been a value stock, there's just a lot of clarity into the future. So management executes a 14% revenue growth at a 31.5% margins. The canceled Warner Brothers deal de-risks the balance sheet and heavy buybacks to compound earnings per share. I'll let you pause to read the rest. Essentially, Netflix has an amortization wall at this point because they can spend so much more than their competitors profitably run their business that nobody can catch up to their content creation budget. I'll let you read the second half. Now, the next company I bought today was the Walt Disney Company, target price of $125. And the thesis here is that the direct-to-consumer streaming, i.e. Disney Plus, can achieve a structural 10% profitability. And the experiences are really the core of the business. You know, the only concern for this one was that the linear television was going to continue to erode, but we knew that was going to happen. That's already been priced in, and it's a small part of their business now. I think it's like 8%. The Disney Plus part could have been just a total dead duck, right? You know, maybe just people weren't going to subscribe to it, but now they seem to have reached an escape velocity with it, so it is no longer a risk at all that the Disney Plus portion, the direct-to-consumer portion, will be profitable. It'll be a nice, big, profitable division. That means that the crown jewel, i.e. parks and cruises and experiences, will continue to make a lot of money, and they have really insurmountable moats. Nobody's competing with Disneyland. The last one I added was Wells Fargo. Now, the banks in general have been beaten up tremendously, all the financial stocks, some fairly, some not so fairly. I think Wells Fargo is the safest of them. And the big catalyst is there's a lifting of the Federal Reserve asset cap. Represents a structural, knowable unlocking of Wells Fargo's $1.36 trillion deposit base. Imagine $1.36 trillion. They pay almost nothing for this deposit base. It's, they're able to loan it out, and it's all profit. So they can shift their capital allocation from defensive share repurchase to high return on organic loan growth in commercial and consumer segments. Not investment advice. Let me know in the comments what stock you